Joining us now is Jefferies chief market strategist and CNBC contributor David Zervos, along with David Kelly, the chief global strategist at JPMorgan Asset Management, and Stephanie Roth, she's the chief economist over at Wolfe Research. Great to have you all here. David Kelly, I'll start with you. We last spoke on the day the Fed was meeting, and in retrospect, what should they have done, do you think?
Well, I think they should have started cutting earlier. And the reason they should have started cutting earlier is because then they could talk about normalizing, because honestly, inflation was headed back down towards 2%. And what you want to do is cut rates, but say, it's all fine, don't worry about this, we're just normalizing here. Now the problem is that if they cut rates too aggressively, everybody's going to get scared. And so the most important thing they can do from right now is recognize what Steve was saying. The consumer is still okay here. I think the market had a huge rally. I mean, we were up 57% from its lows in terms of this stock market rally. So we're certainly overdue for a correction. But the economy does not have that exuberance in it. We don't have exuberant level of home sales. We don't have exuberant levels of vehicle sales. We don't, I think, have exuberant levels of investment or hiring. We've got 8 million job openings. We've got huge increases in wealth. We've got rising real wages. So to me, that doesn't amount to an environment which will slide us into recession. I think we're seeing a downshift in growth. We're not headed towards recession. But if the Fed looks like they're spooked and they scare people, that could make it more of a danger.
David Zervos, very curious for your take. I know you've been more kind of steadfastly bullish on this cycle for the past couple of years as the haters have multiplied. Where are you now?
I'm not in much different of a place, Kelly. I think the market is normalizing. That's what Jay said on Wednesday. The labor markets are normalizing. We're moving to 4.3% unemployment rate. I used a statistic earlier today in another segment on CNBC to say that decade of the 1990s, that wonderful decade that we all loved, where the markets just went up and we had strong growth and low inflation, Goldilocks, you know that 9.5 of those years, the unemployment rate was above 4.3%. It was only in the summer of 99 that we broke through 4.3. The level of the unemployment rate is still very low. I understand we've moved up and we've moved up a little faster than people may like, but we still are not at some sort of place that I think requires us to think about an excess amount of slack in the labor market.
So what do you mean?
I'm not getting super excited about this storyline that recession is either happening now or immediately on the horizon.
Because you wear both hats so well, both macro and markets, most of the markets people go, look, we hear the macro narrative, but we're watching the 2-year yield plunge a full point in 4 weeks' time. That doesn't set off your sort of, spidey sense a little bit?
No, I do. And I think there's a lot going on. There's a whole new presidential race that we have to try to deal with and think about. We're trying to learn about a new candidate that is running on the Democratic ticket. We've seen a big change in the odds. We've got geopolitical risks that are really elevated after what's happened in the Middle East over the last week. And we've had a fairly sizable change in Japanese monetary policy and a very, very big move in the yen, where a lot of the carry that those market folks have been enjoying has been expunged from the market. So big moves in dollar China, big moves in dollar yen, big moves in a lot of crowded trades, Kelly, that I think in August get exacerbated by the fact that people may have already taken that vacation that Steve was talking about earlier in the program, and we may have the kind of second-tier folks on desks, and that may create that vacuum of liquidity that gets us a VIX spike like what we got, or a 2-year note yield spike down.
I hope I'm going to sick them on you. The second-tier people on the desk, they are going to rise up.
I call it the acne trade.
The acne trade. Stephanie, jump in here. What do you think?
Yeah, I think we have to remember that the market has been going in 3-month periods of time where it's been swinging in terms of expectations. If you rewind back just to a couple months ago, we were concerned that the economy was overheating. Rates were around 10-year rates were around 4.7%. And there was concern that the job market was too hot. And now we've just kind of reversed that to some extent. I would owe a lot of that to seasonal factors, especially in Q1. Seasonal factors pushed up both growth and inflation, and now we're just reversing that. So if you look through the trend, the economy is running at an okay pace. It's still running around 2%. Inflation is now back down below 2.5%. So we're in an okay place. It's just the market is kind of taking the narrative and running with it. If you look at the jobs report in and of itself, 114,000, certainly a soft print, but not something that should be that onerous or concerning. It wasn't negative. It was still above 100,000. The average historically is somewhere above 150 to 175,000. So it's not as if we're in that bad of a place. It's just the market narrative has taken it and run.